Imagine this. You've worked for decades, saved diligently in your 401k and your IRAs, and finally you reached retirement. You've done everything right. Then one day comes along and you get a letter from the IRS politely reminding you it's now time to start taking your required minimum distributions, and suddenly your financial freedom feels a little less free because now the IRS decides when you take your money out of your retirement accounts and how much. And every dollar that comes out is 100% fully taxable, whether you need that money or not. Those withdrawals can push you in the higher tax brackets, increase your Medicare premiums, and make your Social Security more taxable. Here's the part most retirees don't realize. The IRS wants you to wait until the last minute to plan for this because that's when they collect the most tax. But if you understand the right strategies, you can legally shrink your future RMDs, lower your lifetime tax bill, and take back control of your retirement income. That's what I call the RMD strategy the IRS hopes you never find out about. Hi, I'm Mark Wisniewski, president of Southern Incomes. If you find this helpful, make sure to like and subscribe. And if you'd like to see how these strategies could work in your situation, book a time with me using the link in the description. Because once you understand how RMDs really work and how to plan for them, you can keep far more of your hard-earned money in your retirement. Let's break it down. 1, what RMDs really are and why that matters. RMDs, or required minimum distributions, are the government's way of finally taxing all that money you've been deferring for years. Let's face it, you've got the deduction when you contributed to your IRA or your 401k. You didn't pay taxes while it grew, but once you reach age 73 or 75 if you were born in 1960 or later, the IRS says now it's our turn. Each year you must withdraw a portion of your overall balance, and every dollar you withdraw is taxed as ordinary income. The larger your balance, the larger your RMD, and the bigger your tax bill. Those withdrawals can also push you into a higher tax bracket, make your Social Security more taxable, and trigger higher Medicare premium IRMAA penalties. That's why many retirees with 7-figure IRAs, well, they're shocked to realize how much of their retirement income actually goes straight to taxes. I talked to people who did not prepare for this, who've told me things like, Mark, I walked around in a fog for a year after paying that huge tax bill. But here's the thing, you can't stop RMDs, but you can reduce how large they become. 2, the hidden opportunity before RMDs begin. There's a 5 to 10 year window that's one of the most powerful planning periods in retirement, and most people waste it. It's the time between when you retire and when your RMDs kick in. So usually it's your early 60s, right in the early 70s. And I call this your tax window. During this time, your income is often lower. You might not be working anymore. You've not started Social Security yet, and your RMDs haven't kicked in. That means you have a unique chance to take control of your future tax bill while your rates are still low. The goal? Reduce the balance of your tax-deferred accounts before RMDs begin, legally and strategically. Here's how. 3, strategy 1, the Roth conversion ladder. A Roth conversion, it lets you move money from a pre-tax account like an IRA or your 401k into a Roth IRA. You pay taxes on that amount now, but from that point forward, it grows tax-free, and Roth IRAs have no RMDs during your lifetime. No more taxes. By converting in smaller chunks each year during that tax window, you're paying taxes at lower rates now, shrinking your future RMDs, building a pool of tax-free income for later. For example, if you're married and say you're in the 22% tax bracket, you might convert just enough each year to fill that bracket without jumping into the next one. It's not about paying more taxes, it is about paying them smarter. And once your money is in a Roth, the IRS can't force you to withdraw it. 4. Strategy 2. Qualified charitable distributions, or QCDs. If you're 70 and a half or older and you give to charity, this one's for you. A qualified charitable distribution lets you transfer money directly from your IRA to a qualified charity. So that amount counts towards your RMD, but it does not count towards your taxable income. So instead of taking your full RMD, paying taxes, and then writing a check to charity, you can give directly, reducing your taxable income and satisfying your RMD at the same time. It doesn't get any better than that. And even if you don't itemize deductions, you still get the full tax benefit. If you already give to your church, a foundation, or a nonprofit, QCDs are one of the most overlooked ways to cut your retirement tax bill. 5. Strategy 3. Controlled withdrawals during that tax window. You don't always have to convert a Roth just to reduce your future RMDs. Sometimes simply taking planned withdrawals from your IRA during your 60s can smooth out your tax burden. So think of it like letting pressure out of a balloon slowly before it gets too big and bursts. By taking smaller distributions each year while you're in that lower bracket, you reduce your account size and those future RMDs without spiking your taxes later on. Not bad. This works especially well if you delay Social Security until 67 or even 70 because your income stays lower while you're drawing from your IRA strategically. You're essentially paying taxes on your terms rather than the IRS's terms. 6. Strategy 4. The in-plan Roth conversions for those still working. If you're still working in your 60s and have a 401k, your plan might allow what's called in-plan Roth conversions. What's that? Well, it's moving part of your pre-tax balance to the Roth side, all inside of your company plan. Here's why that's so powerful. You pay taxes now at known rates. The converted amount, it grows tax-free from that point on. And under the new Secure 2.0 law, Roth 401ks no longer have RMDs. That means you're converting retirement money into a tax-free zone before the IRS can force you to take withdrawals. And once you retire, you can roll that Roth 401k into a Roth IRA, keeping it completely outside the RMD system. 7. Strategy 5. If you're still working at RMD age. Here's a rule most people don't know. If you're still employed past RMD age and you don't own more than 5% of the company, you can delay RMDs from your current employer's 401k until you actually retire. That gives you extra years of control. And if your plan allows roll-ins, you might even consolidate older 401ks into your current one to delay RMDs even further into the future. It's one of the simplest ways to buy more time from Roth conversions or controlled withdrawals. 8. Why the IRS hopes you never use any of these rules. Let's be honest, tax-deferred accounts were created because the IRS knows they'll get paid later, often at higher rates. Most people don't plan ahead. They wait until RMDs hit, take whatever's required, pay whatever taxes come due, and that's exactly what the IRS wants. But when you start planning early, using Roth conversions, QCDs, and those controlled withdrawals, you're playing by the rules intelligently. You're not avoiding taxes. You're managing when and how much you pay, so the government doesn't decide that for you. And the earlier you start, the more options you have. 9, the big picture. RMD planning is lifetime tax planning. Here's what this all means. RMD planning isn't just about what happens at 73. No, it's about everything you did in a decade beforehand. Because if you act during your 60s, you can reduce your future taxable income, lower lifetime Medicare premiums, protect more of your Social Security, and create true flexibility with tax-free Roth income. That's how you build a retirement that's not just sustainable, but strategic. So here's the takeaway. RMDs are inevitable, but how big they are and how much they're going to cost you is entirely up to you. The IRS isn't going to remind you to plan ahead. No, they're counting on you not to. If you want help designing a personalized RMD strategy, one that coordinates Roth conversions, controlled withdrawals, and charitable giving, all to minimize your taxes, book a call with me using the link in the description. I'll show you how to turn your savings into a tax-efficient income plan that keeps you compliant, flexible, and in control for the rest of your life. Because when it comes to RMDs, you can follow the IRS's rules or you can use them to your advantage. The choice is yours.